Hello and welcome to UCI Beal Applied Innovations VC Speaker Series. This is our webinar featuring conversations with VCs and investors. Our goal for this webinar series is to continue to connect the Southern California innovation ecosystem with the experts and the resources that will help entrepreneurs and founders navigate this current crisis and thrive in the recovery that we all know is coming. For today's webinar, we are honored to have with us Paul Voois, who is the manager with the Cove Fund. The Cove Fund is a family of seed stage venture capital funds that provides startup funding for promising Southern California ventures. The fund is headquartered at the Cove at UCI Beal Applied Innovation, where, as many of you know, that's where I work as well. So there should be lots of good things to talk about. Before we get started, I'd like to thank our sponsor for the VC Speaker Series, Kenobi Martins. Kenobi is consistently ranked as one of the top intellectual property firms in the nation and worldwide. Kenobi Martins has close to 275 lawyers and scientists and dedicates its practice to all aspects of the intellectual property and technology law, including litigation. The firm's headquartered here in Orange County, and we're very fortunate at UCI Beal Applied Innovation to have Kenobi as strong supporters of our mission and of the VC Speaker Series. More information about the firm can be found at www.kenobi.com. So a few webinar details. So I say this all the time, and I'm sure you know it, but unlike a lot of the Zoom meetings you've been on for the last 4 or 5 months, you can't unmute yourself on this and you can't turn on your video. So if you have a question, we'd like you to type it in the Q&A box that you'll see at the bottom of your screen. So don't put it in the chat box because we don't monitor that. And throughout the conversation, I'll try to get to some of those questions, and we'll definitely allow time near the end to finish some of those questions with Paul. And Paul and I might hang on to that Q&A area a little bit even after the webinar ends and just privately answer some of those. And finally, this webinar is going to be recorded, and by early next week, it'll be available on the UCI Beal Applied Innovation website and on our YouTube channel. So with that, Paul, if you could go ahead and fire up your video. There you are.
Hey, Luis, how are you?
Hey,
hello,
good.
everyone.
Good to see you. Well, how you doing today?
I'm doing great. Looking
Good,
forward to
good.
our chat here.
Oh, good. Well, we're looking forward to this conversation. You know, obviously we're work physically close together, and you know, I work at the Cove. Your fund's based at the Cove, and as I mentioned to you during our prep call, you know, I'm very eager to further get the word out about this because, you know, not simply because we work closely together, but in working closely together with you guys, I've just been very impressed with the way you work. I like the process. I like the managers. I really like what you guys are doing. So I'm looking forward to kind of spreading the word out beyond kind of our immediate networks. I really appreciate that. So before we get into the Cove Fund, though, you know, I'd like to get a little bit of background from our guests so that our attendees can kind of know you a little bit better. So what did you do before becoming a manager at the Cove Fund?
I was an entrepreneur, which I think really set the table to become a venture capital investor. So I founded or co-founded a company called Clarify Communications in 2004. We actually started the company up in Sacramento, but moved to Orange County to be able to hire really, you know, A-level top flight talent. Clarify still is a semiconductor company building chips for optical internet infrastructure. And we started here in 2004. We ended up selling the company in 2016 to Inphi, Silicon Valley chip company, and Clarify is still a very successful business unit with a significant operation in Irvine, but now it's part of Inphi, and I've shortly after the acquisition, I started moving into venture, and here I am. Okay,
good. And listen, starting a fabless semiconductor company was, let's not say it was easy, but you know, it was more common when you did it. Selling it when you did was a challenge. So congratulations on that.
Thank you. Yeah, it was a long haul, but worth every second.
Okay, and you know, you actually don't have a lot of entries on your LinkedIn or resume for like full-time jobs. So before that, you worked for 8x8, and you had a kind of a pretty interesting career there as well, right?
Yeah, very. And I guess to put it in perspective, this was in the mid to late 90s. So it was in, you know, right in the midst of the .com craze. But I joined 8x8 after getting my PhD from Stanford in 1994. and started in engineering. And really through a combination of hard work and being in the right place at the right time and pretty unique circumstances, I moved up the ladder there very quickly. Moved into engineering management, led the development of the product that eventually took the company public in 1997, and then eventually actually became CEO of the company as a public company. So, there's a long story there as well, but I'll just leave it at that. It was very interesting and great experience.
Yeah, no kidding. And we can probably go into that quite a bit. But I did catch something when I was reading up on your bio that one of the things you did is you worked on their consumer video phone business back in the day. So
Back in the day.
gosh, so 20 years ago, did you ever envision or imagine that this level of video calls would be happening, that people would be spending 4 to 5 hours a day or more on video calls? Did you guys envision any scenario like that?
In a sense, yes, because that really was the thesis on which the company went public. But we didn't really know what the timing was going to be. And the reality was back then we were transmitting video at 30 kilobits per second over analog phone lines. And you need 10 to 100 times that bandwidth to get quality video. So we had the vision. Of course, we could have never anticipated a pandemic causing the behavior to become mainstream.
Right.
Yeah, we thought people would eventually, use video as a regular everyday communications tool.
Cool. Good. All right. So then from there, I guess, we kind of covered those. So let's dive into the Cove Fund. And we wanted to start with a little bit of the history, but, interestingly enough, neither one of us was around right at the very beginning, but, we have plenty of reliable sources. So why don't I kind of give a little bit of the early history, and then you can kind of jump in when you did. So, the Cove Fund, the idea and the early organization for the Cove Fund came from Richard Sudek, who's the executive director at Beal Applied Innovation. And, soon after creating what was then known as Applied Innovation, he saw the need for a fund that would invest in pre-seed and seed companies that were Orange County based and had kind of a strong UCI connections. Many of you guys know that Richard was formerly the president and one of the early members of Tech Coast Angels. So he also saw that at times angel groups were kind of moving, as Richard says, upstream a little bit. So he saw a need for a venture firm that was very aggressive at looking at pre-seed and early deals. So that was his thesis, and he went out and he recruited 3 fund managers that would oversee this fund, and they established a structure of the fund, and they began fundraising. And those managers were John Kinsey, Hans Imhoff, and Fred Selvey. And I think we're lucky enough to at least have John with us in the audience. I saw him as one of the participants, so that's great. Hi, John, and thank you for doing this. So one of the unique features of the Cove Fund is that it has very low fees and reduced carried interest. And we'll let Paul describe that a little bit earlier. So that Cove Fund 1, those investors came largely from Orange County sources, from Richard's network, from John, Fred's, Hans' network, et cetera. And they brought together entrepreneurs, successful business people, some Tech Coast Angels, and all of those that kind of had an interest in building something up here. So they were able to raise a total of $5.62 million from kind of private and institutional sources. And one of those later investors that came in the end was Paul, our guest. So that's when you came in, Paul. So I'll kind of stop there, and I'll let you kind of take over from there. So you joined near the end of the fundraising period. So what made you want to invest? So kind of take off your now the manager hat and take on you're an angel investor, you're a private investor. What made you want to join Cove Fund 1?
I'll answer that in a second, but just let me add that both my partners, Howard and Mike, also came in through the same route. So the 3 of us invested in Cove Fund 1, and that kind of led to Cove Fund 2 in a sense. But in terms of why I invested, so Richard reached out to me. He was very active in fundraising and trying to rally the community to support this fund. And at the time, I was still at Clarify, and we hadn't even sold the company yet. But I had already, I could see that coming, and I knew I wanted to get more into investing. I had joined Tech Coast Angels a year or so before. So I saw it as an opportunity to get, more involved in the ecosystem, more involved with UCI, access to deal flow. and just a way to build my, angel investing practice. I had no idea it would lead to managing Cove Fund 2. There wasn't really even talk of Cove Fund 2 at that time, but
Right.
I knew it was the direction I wanted to head.
Oh, cool, cool. So how Cove Fund Cove Fund 1 is fully invested. So how have those investments done?
Mostly good. I think, invested in 21 companies, and the period here was like 2015 to 18. So when you look at seed investments, and Cove Fund 1 actually was like early seed. So typically you're looking at 4 to 7, sometimes even 10-year return periods.
Yeah.
So most of those companies are still operating. A few have had really nice gains on paper. Still looking for the exits to start, but overall the portfolio is doing pretty well.
That's terrific. So I mentioned a little bit earlier the kind of the low fees and reduced carried interest. So first of all, I always like to make sure we're kind of fair audience. We're deep inside this. Can you tell us first of all what that means? And then more importantly, tell us kind of how Cove Fund is different in that sense, and how that works for you and the other managers, and how it worked for the managers at Cove Fund 1.
Sure. So just by way of definition, so virtually every venture fund has these two metrics in terms of economics of the fund: fees and carried interest, as it relates to the management of the fund. So fees are the expenses, whether that be salary, rent, whatever, that the fund spends. And typically those are, identified on a yearly basis. So for example, 1%, 2% per year, and it's relative to the total capital in the fund. So if we're a $14 million fund, our fees are a percent of that $14 million per year. Carry is the percent of the profits of the fund that get paid back to the management. So it only applies to profits after the original capital has been paid back to investors. But that's really where, hopefully that's where most of the money is made by the management of the fund.
Go ahead.
I'll keep going. So what makes Cove Fund unique is that, we leverage, let me back up a second, to make the economics of a small seed fund work. You have to do something different than your typical, $500 million Silicon Valley fund, because they can charge 2% a year. That's millions of dollars in fees. They can pay staff. They can, have a fancy office, et cetera. When you have 14 million, you just can't you can't charge a high enough fee to really pay for a typical fund operation. So we are very much member driven. The managers work for carry, but not for salary. We don't take cash salary, and we keep our expenses very low. For example, we reside in normal times at Applied Innovation there. UCI gets a part of the carry, but there's no cash. We don't have cash rent per se. And we, as opposed to hiring staff, we rely on our members to do a lot of the heavy lifting of the investment process. So that enables us. Our expense is about 1% per year, and our typical carry for a venture fund is 20%. Ours is around 12%.
Yeah, listen, that is creative, and you're right. It was driven a little bit by the size of the fund, but also driven by the people that are around it, and frankly, it's I'd say it's challenging to even compete with that, right? I think I've talked to other hopeful fund managers who kind of looked at that and like, gosh, how can we make the numbers work? And that is challenging. But for the investors, as you can imagine, for our attendees, you can imagine, instead of kind of losing 2% a year, which over a 10-year fund, it ends up being 20% of your total investable capital. And so, having more capital to invest is going to give you more opportunities for success and more returns on that. So it's really appealing to the investors that are in it. So that ends up working pretty well. So it was really, great credit to Richard, John, Hans, and the team, and Fred, that figured this out early on, that to kind of get away the work, and certainly to you guys that have put it forward. So you're an investor in Cove Fund 1. When did the idea for Cove Fund 2 come along? Did you decide, hey, I want to be a manager in Cove Fund 2? Did someone come to you and say, Paul, we want you to be a manager in Cove Fund 2? How did Cove Fund 2 come around, and what made you want to take on this role?
It kind of happened spontaneously. There was never any preordained plan for follow-up funds. I think it was always assumed that there may be one. But in 2017, when we were a couple years into Cove Fund 1, there started to be some questions among our members. Hey, is there going to be a Fund 2? What's it look like? And my partner, Mike Benvenuti, called me one day and said, hey, do you want to do Cove Fund 2? And I said, sure, I'd love to. And same with Howard. And so we were kind of the ones that just stepped up and did it, and got a lot of support, and it caught fire from there.
So you guys did a lot. You guys did most of the fundraising as well, right?
Yeah, I mean, obviously we had help from the ecosystem in the community, but the first, I'd say, so we probably, the idea was spawned in mid 2017, let's say. By the fall of that year, we were fundraising, and the fundraising took about 6 months, and we opened for operations in, I think, like Q2 of 2018.
Yeah.
It's about a year to get from concept to getting the funds going.
Right. And listen, I'll say from my perspective, and, for the benefit of our audience, that's fast. Certainly, yeah. even for a second fund with a good track record, that's still a fast time to get to the point where you're fully subscribed and you have that. So congratulations to you guys. So Cove Fund 2 expanded the criteria, though, of what it was looking at, right? So from an investment criteria, what does Cove Fund 2 look at as opposed to what Cove Fund 1 did?
So a couple main differences. One, the fund is bigger. So we had the first fund was just under 6 million. We hoped to match that, actually, and our stretch goal was 10 million when we were fundraising, and we actually ended up at over 14 million. So we were, surprised and thrilled at that. So that allows us to not necessarily write bigger checks for the first investment, but put a lot more money over the lifetime of a company into each company. I think that's the big difference there, which is, I think, gives the companies more comfort that we can support them beyond that initial investment. And then the other big change is we expanded our geographical region to all of Southern California. Fund 1 was Orange County only. A lot of good deal flow there. We invested in over 20 companies. But by expanding to particularly San Diego and LA, we multiplied the deal flow by a significant amount. We still do, I'd say, most of our hunting, so to speak, in Orange County and San Diego, but it's really allowed us to, I think, just the top of our funnel is there's more volume at the top of the funnel, and then through our kind of vetting process, we believe we can end up with more selectivity to get kind of the same number of deals at the end.
And probably some of you who registered for this saw that this kind of data point in the registration materials, but Cove Funds are actually the most active investor in Orange County companies. So if you measure it by where are the companies that received the investment over the last 24 months, so we're really looking at who's investing now. Cove Fund 2 is the most active, twice as many as the second place fund. So yeah, very active here in Orange County companies. So how about sectors? What types of sectors does Cove Fund 2 look at? What kind of technologies?
So we're generalists. We operate bottoms up as opposed to tops down. So just to define that, a tops down would be a fund that only focuses on B2B SaaS or medical devices or whatever. We focus on individual investment opportunities. So from a sector perspective, we will look at any company that has a defensible IP position, defensible technology. That could be in classic technology. It could be in life sciences, medical devices, whatever. That said, over the life of the two funds, we've grown some expertise in particular verticals. Among them, SaaS, software as a service, has become, I think, quite a strong practice for us. Medical devices is another, and then I'd say e-commerce, particularly direct-to-consumer e-commerce. So those are some of the sectors we've just gravitated to, but we'll look at any technology-based deal that we think offers a good investment opportunity.
Okay. Lost you there right at the very end. Hopefully it'll come back here. So, so does it also extend to, and this will take care of one of the questions in there, extend to water resources? Oh, excuse me. Now my internet's a bit unstable. Okay. Hopefully I'm back. So does it extend to water technologies, sustainability, that area, as well as life sciences?
Yes, like blue tech. We've looked at some. I don't recall having made an investment in blue tech for Fund 2. We've also looked at several e-vehicle deals and green energy deals. Have not found one yet to invest in, but certainly, again, those are definitely within our space.
Okay. So obviously we're no pre-seed, very early, but how about revenue traction or, technology development? When realistically does it kind of make sense? And it depends by sector, believe me, I know that, but kind of how much progress do you like to see in the companies when you guys come in?
So I'll give you kind of our typical profile, but no deal is absolutely typical and certain things trade off against other things. But the typical profile is, I think, pretty normal for a seed stage raise. So you've got a formed management team, could be, typically I think we have 5 to 10 people, a couple founders among those, at least a product MVP. So, not all necessarily, but a significant amount of the product risk has been taken out. And then evidence of product market fit. And that could be pilots, beta customers. I mean, obviously we like it if you actually have a paying customer. That's always the best evidence of product market fit. But, we've done pre-revenue deals. We've done companies that, are doing 5 million a year in revenue. So again, it's just, if the idea is just explosive and the management team is great and we think this could be a home run, then maybe we do it pre-revenue. Whereas some deals are just, much lower risk, probably lower return, but, we'll do larger revenue. Then as the fund matures, we're getting through our investment period now. We're actually looking more, I'd say, late seed, early Series A, just because we've got a fixed window where we want to exit our investment. So as we get close to that window, we're looking for opportunities that hopefully, theoretically, have shorter times to exit. Okay.
Generally speaking, how about check size?
That's one of the areas where we're unique. So Cove Fund will typically write a first check in the 250 to 400K range. But our members, that's our investors, co-invest. We get a certain amount of member co-investment on every deal we do, and that will typically put us for a total first investment in the 500K to 1 million range. We've gone as high on certain deals as 2 million between the fund and its members, but it's more typically in that 500 to a million. But then over the lifetime of the company, we allocate at least 1-to-1. So if we as a fund invest a certain amount in the company, we'll reserve that amount for future investments. And usually it'll be multiples of that amount as long as the company continues to make progress.
Yeah, so clearly kind of good leverage on both sides, right? So
yeah.
Leverage on the types of deals that the fund could look at, and leverage, I'd say, for the members as well, because you've got members who are now getting kind of access to the deal flow and the due diligence. And if they can make some direct co-investments, and that lowers their costs even further. Mm-hmm. So, good return for them.
It's a win-win, and it helps us. It allows us to punch above our weight fund size. I think we do bigger deals and better deals than you would expect from a $14 million seed fund, because we have that capital behind us.
Right. Okay, so any types of technologies or opportunities that you personally, or you as the manager of Cove Fund 2 are interested now? So what's kind of really interesting to you right now?
Well, it's funny. I mean, my DNA is in communications and semiconductors, and that's with some exceptions kind of a desert from an investment environment. There's some good hardware and chip deals, and we actually did a few in Fund 1. We haven't done any in Fund 2. I go where the action is. So I've done several SaaS deals, particularly business to business SaaS. It's a great investment model, great business model. Capital reasonable, recurring revenue is great. You can see in the public market, SaaS companies are extremely well rewarded in terms of multiples. E-commerce, both on the infrastructure side and direct to consumer, is another area of interest. And then we've got some exciting medical device companies as well. And I think that's a real strength of Orange County and San Diego. And, that's a space we like as well.
Yeah. What I'm hearing a lot right now about medical devices is kind of twofold. One is that just the current environment is, shining the spotlight on healthcare again, which, that's a tailwind. And then secondly, it's somewhat, kind of economic cycle agnostic, right? You can say, well, this is going to take some time to get through the regulatory process. By the time we get there, it kind of doesn't matter where the market is at that point. So, there's going to be kind of a consistent demand for those. So yeah, medical device is a nice little kind of, counter-cyclical type of opportunity.
Yeah, I agree, for sure.
One you didn't mention it, but someone asked it, so I'll throw it out there. How about space technologies? Do you or any of your members kind of interested in space technologies?
Intellectually, I'm interested. What you usually find in those is they just huge amounts of capital requirements. I mean, if you're talking about launching rockets to the moon or Mars, I mean, that's way, way, way outside our capital capabilities. If you scale it back a little bit and look at things like drone technology and more, very low orbit space, which is anything off the ground, that's definitely an area of interest. We've looked at a lot of those deals. Haven't pulled the trigger on one, but a lot of drone stuff going on, and just autonomous vehicle in general.
Right. Okay. How about the other side of the coin? What are some areas that you think have some headwinds right now, or would give you pause when evaluating an opportunity in that space?
Well, one thing is valuations are surprisingly high. Now, this is a two-sided coin. That's great for entrepreneurs in terms of being able to raise money at relatively low dilution, but it makes things tougher for investors to create an investment model that generates the right returns. We thought that valuations would go down in COVID, but it didn't happen. And if anything, it's actually gone the opposite way, just like in the public markets. I mean, the public markets have just gone crazy in COVID. And I think that's because investing now is dominated by COVID-friendly companies, at home, work, like you said, healthcare, e-commerce. So we're seeing those deals, but they're actually getting pricier as investors. Yeah. We still invest. I mean, if we like a deal, we'll bite the bullet and invest at a higher than comfortable valuation. But we're just seeing that trend.
Right. So seed deals are definitely getting done right now, though. So if what you just described is, valuations really aren't going down, and in some cases are kind of going up, then you're not only are you guys investing, but are you seeing seed deals getting done in other areas?
Absolutely. Yeah. And in fact, when COVID hit in March, we never went into hunker down mode, but we anticipate, our worst case was we're just going to have to make sure our companies are, get through this and reserve enough cash for that. But the reality is deal flow has not slowed down. Maybe for a month it slowed down a little bit, but we've done several deals since March. Really great companies. They do typically, have COVID as if not a if not a tailwind, at least aren't, like bars and restaurants. They're not getting funded these days. But yeah, there's a lot of deals getting done. Really good companies. We've made some very exciting investments this year, actually.
Yeah. I think it kind of it backs up, I think, a little bit of one of the theses I have, that if you look at the big numbers for the first half, and we got these numbers from PitchBook recently when their first half report. And one of the things that they showed is that the way they track it, angel deals and seed deals kind of track together. And they call a seed deal as essentially something that a venture firm, an organized venture firm, invests in a seed deal. An angel deal is obviously that. It's an angel group or an angel individual investor that's investing. So they kind of track those, and those move in parallel. This year they've split. Angel deals have maintained their pace more or less in terms of number of deals. Venture seed deals have really taken a hit. So whereas they were moving along kind of at the same, venture seed deals really fell off. So Cove Fund notwithstanding. My idea of like, why is that happening? I'd like to get your sense on it too, is that angel deals generally have a relationship, a pre-existing relationship somehow. You reach out to angels that you know, or angel investors that you know, and somehow there's that personal relationship, there's that history that does that. So those have been able to kind of maintain. Seed VC deals, where there's probably first money in to a brand new team and a brand new relationship, that's been harder to develop in the age of Zoom, et cetera. What I think helps organizations like the Cove Fund and Tech Coast Angels and other angel groups like that is that you leverage your network. I mean, you've got 99 members that, you know, likely could have a relationship with one of the companies that come in, or you can quickly get to someone who knows that. So you kind of eliminate some of that kind of the unknown of not having a pre-existing face-to-face relationship with someone. Do you think, what does that theory sound like to you?
That's true to an extent, for sure. I would say all or virtually all of the deals we ultimately invest in come in through our network. You know, we do very few kind of cold calls that end up being, you know, going all the way through, especially in COVID when you just can't, you know, you can't go kind of meet face to face. So we're seeing that kind of, you know, highly curated deal flow that exists in our network. We've certainly done more what we call follow deals as a following investor, where there's maybe a local venture firm, or not necessarily even local, that's leading the deal, and through our network we're introduced to it and come in, you know, as part of the syndicate. Right. So that could very well be. There were some VCs that, you know, hunkered down when COVID hit. I think seed has been going down in number of deals anyway over the last couple of years, not necessarily in deal size or even amount, but if you look at number of deals. So, you know, I only see a sliver, and that sliver is really colored by our network. And in that ecosystem, things have been pretty good. Yeah, yeah. So I'm going to a little address here to the folks putting in questions. So we kind of opened up Pandora's box, because now we've got a dozen entrepreneurs and founders who said, will you invest in this very particular niche? Will you invest in this particular niche? So rather than go through that kind of publicly with everyone else, and I know that it's very important to you guys that put in the question, Paul and I will maybe address some of those right at the end, or we'll address those right in the Q&A box themselves. So if you've got a pretty specific question about will Paul or the Cove Fund invest in a particular area, we'll try to get to those a little bit later. So we've gone around it a little bit in terms of how you leverage your network, how you leverage your members, but can we actually kind of go through what's the process that you go through for kind of from start to investment? What does that look like for a CEO, founder, startup that approaches a Cove Fund? So I'll answer that. We have a structured process, but then there's always things that you do to tailor that to the needs of any particular deal. But I'll give you kind of the outline of the structure. So we source deals primarily through our network. You know, before COVID, we would go to events where, you know, entrepreneurs and investors got together and could source deals that way as well. But these days, it's mainly through our network. And, you know, just as advice for the entrepreneurs out there that are watching here, we do have an application page on our website. You could go in and submit a blind application. I highly recommend that you get a warm introduction to someone in our ecosystem. You will get, just the reality is, you will get much more attention that way, and you'll have more credibility. So we have 99 members. We have 3 fund managers. There are a bunch of people at UCI know our fund, so you shouldn't have much trouble finding someone willing to make an introduction to any of the 3 fund managers, and that's the better way to go than just to lob an application over the transom. Anyway, a deal comes in, we have a pre-vetting process. Usually one of the fund managers will spend, a couple hours just figuring out at first glance if it's a good fit. If it is, we will, the three managers will meet. We generally get together once a month to meet with companies that we like. We call that a pre-screen. It's all done on Zoom these days, obviously. We'll usually pick one or two or three companies out of that group that we want to present to our membership. And once a month, we have a member meeting where our members get together. Usually on any given meeting, maybe 50 will be there, and the companies present, and we discuss as a membership, as a partnership, and decide which, if any of those, we want to kind of go the next step, which would be due diligence. And then if we like the company enough to go to that step, which is really where we start asking members to spend time. So we're pretty careful, out of respect for people's time. It's got to be, I think there has to be a good feeling on the opportunity. We'll put together a diligence team, 4 or 5 members usually, again, with a manager participating. And we try for a 30-day diligence cycle. So from that point, 30 days later, we'll either have a no, and sometimes it's a quick no. Sometimes, usually the way we do it, we can get to no pretty quickly. But anyway, within 30 days, we'll have an investment recommendation. We come back at the next monthly member meeting, present that recommendation formally. It gets approved by our investment committee, which is a subset of our membership, and then we're ready to fund. So that's the structure. Now, the exception is if there's a deal we really like and it's closing in 2 weeks, and this would be a deal where we're a follower, not the lead. Then we've got ways to shortcut this process, because you don't want to miss deals just because your schedule doesn't align with the deal. So usually the schedule works, but sometimes we'll do what we need to do to to invest in a deal that we like.
Okay. So do companies have to submit online? That's one thing I missed. You have the portal. But
eventually, but
okay.
Often we certainly not, I look at companies all the time where it's an email introduction, and I'll tell you my personal process. I think each of the partners does it a little differently. I'll get an email intro. I'll say, if it passes just kind of the very high level sniff test, I say, send me a deck. And let's schedule a call to see if there's a fit, typically a half-hour call. And I think in a half hour, I can pretty much assess, if there's a fit. I can't go into all the details of whether we're actually going to invest, but so that's a pretty good way to just, be able to handle a lot of incoming companies. A half hour per company with a deck can narrow it down, and we'll go from there. But eventually, we do have, we ask companies to do a formal application by the time we get to those structured meetings I talk about, but that doesn't have to be the starting point. I actually just like an informal, personal intro with a deck, and we'll take it from there.
Good. So they get through the manager, then they go through the pre-screen. At the screening meeting, if there's support to go into due diligence, they do that. You assign the members and the managers to kind of manage that process, hopefully wrap it up in 30 days. At a subsequent manager meeting, make the decision from the investment committee from there. So how many members are on the investment committee?
Around 20.
Oh, okay.
Yeah.
So you guys, is it unanimous? What does it take to for the investment committee?
It's a majority. Rarely, honestly, is it fully unanimous. Although I think as we've gotten better at diligence and just our process has been more refined and people get more comfortable with the process, there's not as many what I would call split decisions as there were in the early days. And not all 20 are necessarily on each call. So we've had, especially recently in the last year or so, pretty good alignment between what the managers think is a good deal and the diligence team thinks is a good deal and the investment committee. And again, I think we do a pretty good job of getting to fast no, and everyone appreciates that.
Yeah.
First and foremost, the entrepreneur. I mean, they don't like the no, but they like that it's fast, if that's what the answer is going to be.
Right. So, that kind of leads into one of the things I was going to ask, that I'm fortunate enough to be able to sit in and listen to some of the member meetings. So I can see the companies that pitch there. It keeps me up to speed on what's going through the pipeline there. And And in fact, I've through what I do at Beal Applied Innovation, I've helped a number of the companies with their follow-on rounds of funding or extending the round that you guys are interested in. But I've always been impressed not only with the breadth and depth of the knowledge of your members, but more so, there seems to be a level of trust between the members. And the opinions that a particular member expresses seem to be, from my view, both kind of listened to, respected, and processed within that. Did you guys do anything special to develop this level of trust amongst 20 investment committee members and 50 to 90 people that might be on these calls? Was that an intentional result, or was that a result of just kind of strong backbone of what you guys are trying to do, strong foundation?
It was certainly a desired result. I can't say any one thing we did to achieve that. I think it's been highly organic. But if you look at the elements, I mean, we've got people that have been working together for 5 or sometimes many more years through Cove Fund 2 or Fund 1 or Tech Coast Angels or UCI, programs at UCI. So we know each other. I think we're all kind of nice guys, so to speak. I mean, when we were fundraising
and
women, sorry about that. When we were fundraising, we didn't, that's a criterion. You always want to work with people you like, right? And we're all, how should I say it, mature, probably in certainly in years, and also in temperament and experience. And we're all experienced investors. So no one's, I don't think there's, everyone knows what they're doing. And so we've just built over and we've done deals, we're kind of 30 plus deals into the whole process. We know each other. We know how, each other's strengths and weaknesses. We feed off that. And somehow it's all just kind of come together. So yeah, our meetings are very productive. And in its own way, Zoom has actually increased that because it makes it it adds a little more structure, and it requires a little bit more patience and I don't know if deference is the right word, but just, collaboration than sometimes you get in person. So that's helped too.
Interesting. Yeah, there probably be some good PhD papers written at business schools about kind of what you just said and the impact of Zoom on that. So, okay, let's talk about some of the portfolio companies. So let's talk about some Cove 2 portfolio companies that you'd like to share with the group as both kind of a case study and also just to let us know what's out there from a technology and startup perspective.
I'd love to. So I'll I think we talked about 3 companies, but I'll do one at a time here. So the first I want to talk about it was our second investment, I think, back in 2018, a company called GoSite. I talked about SaaS being an area of interest or expertise for us. That was our first SaaS deal. GoSite has a platform that helps small and mid-sized businesses manage their online presence. So things like your website, bookings, reviews, payments, everything, a turnkey solution that's everything a small business needs to thrive online. And obviously in COVID times, that has just become ever more mission critical. So they just announced we invested in their seed round in late 2018. They just announced their Series A of over $16 million, 16, which is a monster Series A. Their revenue has gone up by a factor of 4 or 5 since we invested. And they're one of the few companies, my company included, I mean, so this is no knock on companies, but that has actually met or exceeded their revenue projections, kind of from the day we invested. And they are on a real hockey stick. So, we'll see where that goes, but that's just wonderful management team, super strong kind of appreciation of the customer and sales expertise, and they're just firing on all cylinders.
They were actually, I think they made Ben Quo's email this morning. Yeah, GoSite. So they're linking into Shutterstock. So I knew there was some news blurb that came through, and I just saw it on there. So they did a deal with Shutterstock. So no, good for them. Okay, so a good SaaS company, GoSite, onto their Series A. then you wanted to tell us about Vessel Health as well. I'm really excited about
Yeah.
Vessel Health. It's very
So,
cool stuff.
and you've worked with them, and
Yeah.
appreciate the work. You've actually really helped add value to their current fundraising. So we talked about direct to consumer. Vessel is a direct to consumer company that sells an at-home test kit for health, for wellness. And their first product is a 5-minute urine test, where they ship you a little test card with various chemistries on the card. You pee on the card, and 5 minutes later you take a picture of it, and it automatically processes and reports back on like a dozen or so nutrients, vitamins, minerals, hydration, cortisol, and so forth. And then they kind of wrap that in an overall wellness program, all mobile based, where they bring in dietary recommendations. They'll sell you custom supplements. You can talk to live nutritionists, and it's just really, it's very, I think, synergetic with the trend of personal wellness that we're seeing explode, especially among the younger population. So they actually took pre-orders for their card this year, had just phenomenal interest, unbelievable interest, and they're now ramping into production. So they're looking to ship high volumes by the end of the year, potentially really explosive revenue growth company, and really just a company that matches the current lifestyle ethos of of younger generations.
Right, and that's just to be clear. So it's a picture with an iPhone, and then the processing kind of happens on the iPhone. Does it kind of go up to the cloud?
No, well, they have a back end. The picture is taken on the iPhone. It's through an app, but it's all cloud based. And then you can imagine once you kind of start doing that on a regular basis, they can track your data and really help you to optimize your health. And there's very strong scientific evidence on each of these nutrients, being important to one thing or another: skin tone or sleep or performance or mood or whatever.
Right, and dare I say, it's not simply the once a year maybe snapshot that you get when your doctor orders your full labs, right? And
well,
so
that's the thesis. Yeah. Instead of once or twice a year for several $100 per shot, this is a 5-minute $10 test that you can do every week or every month or whatever works for you.
Somewhat continuous. Very cool. Okay, tell us about the third one, and then I think we're probably going to have to start to go to some of these questions. We've quickly filled up our time here.
So the third one is, so we've done, I talked about GoSite, SaaS, Vessel, direct to consumer, and picked a medical device company, Carlsmed, as our third company. This is a more recent investment, super exciting. Carlsmed is builds a custom spinal implant. Basically, they customize the discs and the intra-disc support kind of structures that go into spinal reconstruction surgery. Today, devices used in those surgeries are not custom. They're more off the shelf. So the surgeon is kind of in there during the surgery trying to fit. And that's not the time you want to be, playing Legos, right? Well, you got someone's back sliced open. So using very advanced 3D imaging and artificial intelligence, Carlsmed will 3D print these devices. They're doing great with regulatory approval. They're looking to be in real surgeries, by the end of this year. And this is going to be a real quality of life changer. There's 500,000 spinal surgeries a year in the US alone, many more worldwide. These are complex surgeries that aren't 100% effective, and Carlsmed's device is going to make them much significantly improve outcomes. Great management team, both scientifically and business-wise, serial entrepreneurs on that team. I will just give you, it's kind of obvious from these three companies, our number one factor, and I think it's not really even arguable, is just the quality of the management team. These teams, different strengths, but all have just superb management teams. And that's, at the end of the day, they say bet on the jockey, and we strongly believe in that.
Good. Someone threw up the question there, and good on them. How about any Cove Fund 2 companies that have gone south? And if so, any general reason that lessons learned from that?
Fund two, not yet, no. I think fund one, we've had a few, just probably, factor of being more time. Um, but, some are, I've picked out the ones that are, doing maybe not the best necessarily, but, among the better ones. I think typically, I think we feel good about our portfolio. The companies that struggle, usually it's more a matter of timing and execution, and can they hit that window of opportunity within a given period of time, as opposed to there being some fatal flaw with the business. So the odds are we will have companies zeros out of a 20 company portfolio.
Sure.
But as long as you have a few 10Xs in there, that's venture. But overall, I think I feel good about our portfolio. It's good,
Okay.
good diverse mix, and everyone's kind of moving forward in one way or the other.
All right. What do you see for the future? Do you see a Cove Fund 3 in the future? Do you see them forking in any way to specific sectors or other stages or anything like that? What do you guys chat about?
Yeah, we'll see. I mean, I don't think there's been a lot of discussion. We're still, we've invested a third of the capital in Fund Two. Um, I think there has been some talk, and I don't even know what the latest is, on a life science based fund separate within UCI, within Cove. So I'm not sure how that would affect kind of Cove Fund's future trajectory. But I would say if we continue to perform and establish ourselves as a successful investor and are a good part of the ecosystem there, Cove Fund will continue one way or the other.
Okay, excellent. So, is there anything that we haven't covered yet that you wanted to make sure our attendees kind of heard about?
I would just close with by saying that we, both the managers, Mike, Howard, and myself, and our members, how much we admire and respect entrepreneurs. That is the engine that obviously makes our fund successful to the extent that it will be successful. My personal belief is it's the engine of our economy. It's what makes America work. You're seeing everything you see on the business news today. Those companies that are just dominating those were entrepreneurs 10, 20, 30 years ago, and in another decade it'll be there'll be new names. So, we can only invest in a certain number of companies, but we always respect the entrepreneurs we work with. We enjoy it, and we try to add value. Investment or no investment, we try, to make sure they come away better, more prepared than when they talked to us or when they approached us.
Okay.
So thank you to all the entrepreneurs out there for your hard work and determination and passion.
Good question. That just also came in. I'm glad they brought it up. So, does the Cove Fund compete or cooperate with Tech Coast Angels for deals?
I think that's very cooperative. I actually can't even think of one case where it was ever competitive. We have certainly co-invested with Tech Coast Angels on numerous times. We have several Tech Coast Angel members that are also investors in Cove Fund. So, yeah, that's very cooperative. I think I would say Tech Coast Angels tends to be a little earlier than us, not always,
Yeah.
but like you said, angels and institutional are often different stages. So, but in fact, I think we've co-invested with every chapter, LA, not every, but LA, Orange County, and San Diego, and have great relationships. That and TCA has made great strides in the past couple of years with their funds and just their process as well. So yeah, that's
Okay.
We're
Good.
friends.
And one thing too, I thought it would come up earlier, but we never really talked about it. So just to be clear as well, because there is some confusion about this, and Cove Fund, and we're at the Cove. So how does that work? So just to be clear, the university itself, we're not investors in Cove Fund 2, and neither Richard Sudak nor I that kind of manage this. We're not on the investment committee of Cove Fund or anything like that. So yeah, we're not only distant here by our space here. We're very collaborative. We work very closely together. I think we know what's going on in each other's shop quite a bit. it's despite the similarities in the name. And listen, I think hopefully it's a great brand for us in the Cove, and hopefully it some shares with you guys as well. So listen, I've got one of my tenets is that nothing bad ever happens when you finish a few minutes early. So I think why don't we go ahead and take advantage of that, and we'll start kind of wrapping things up here. Let me bring this one back up. So I wanted to make sure that I thank again Kenobi Martins, where there's a unique intersection of technical intelligence and legal acumen for a world powered by innovation. We really appreciate everything that Kenobi does for us, and we appreciate you, Paul. And I've listed on there on the screen, you can see it right now. So Paul's LinkedIn and the application to where you can submit an application. But if you were paying attention to Paul, find a warm contact. That could be me, that could be one of the 99 members, that could be the 300 people that at minimum that have a close relationship with one of the members there. There's quite a few of them. So Paul was generous, I think, gracious right now. I think what he said to me privately earlier is like, if you can't find a warm relationship, that says something about it. So make sure you do the work to kind of get there. I also want to thank our production technician, Travis Rubido, who works at UCI Beal Applied Innovation. He's our producer on this and is invaluable in helping all of this get together. So we've got 2 VC speaker series in the works for September. I can't give you the exact details on those yet. We haven't quite locked those down, but we will have those. Watch your emails and you'll see those. So I think with that, we'll probably go ahead and wrap it up. And as I mentioned before, for those of you that submitted questions in the Q&A box, Paul and I are going to drop off the video, and everyone else, all the attendees, can drop off as well. But if you've got an open question, hang around and you'll see us type in a question or type in an answer, hopefully on there as well. So Paul, thank you so much for this. This was great. I'm glad we were finally able to get it done.
Thank you very much. I enjoyed it, and thanks to everyone for watching.
All right, everyone, stay safe, stay healthy, and we'll see you in a few weeks. Bye-bye.